Let's get you to the weekend. Let's wrap up this month, this quarter, this week. Live from New York City this morning. Good morning, good morning. Your equity market positive by 0.7%, trying to end this quarter on a high. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, looking to end a difficult month on a high. The government inching towards a shutdown and Detroit automakers bracing for more strikes. We begin with the big issue, a third quarter to forget.
Coming into the end of the month and a quarter.
This environment has been so difficult.
Has been choppy, has been challenging.
Negative momentum in the bond market.
You've seen consumer discretionary stocks coming off a bit.
Higher oil prices.
Inflation actually gets tailwinds right now between wages and oil prices and a host of other factors.
You're still in this fuzzy period of time here where it's unclear if it's just a give back from the strong summer months.
As we look to fourth quarter in 2024.
The fourth quarter's got these weird things.
Whether it's the strike, whether it's the shutdown.
Student loans restarting.
The market is likely on better footing in the fourth quarter.
You should be starting to see an inflection point in earnings after 3 quarters of negative earnings growth.
Earnings are going to continue to grow.
We're circling this earnings season as a critical one.
The risk for the fourth quarter is, can the consumer continue to surprise on the upside?
There's still challenges ahead.
Joining us now to discuss is SocGen, Subhadra Rajappa, Dan Suzuki of RB Advisors. To the both of you, thanks for being with us to wrap up the week, the month, the quarter, and get ahead to October and Q4. Subhadra, can we have any confidence that yields are going to fall when we have very little confidence as to why they're higher?
That's a very good question, given the fact that we've seen this sort of precipitous rise in yields in a very short amount of time. It's really hard to know where we go from here. I wouldn't be surprised if we head towards 5% because of the momentum, or we start heading lower if the data actually surprises to the downside. So to me, the risks to yields are somewhat symmetric at these levels. But you know what I'd be looking to see from here on is the data. We get inflation data as well as employment data before the next FOMC meetings, and we'll be looking to see what the reaction is in the market to the shutdown. Typically, the bonds tend to rally in a shutdown, but really we've also seen a little bit of a buyer strike. So we'll have to see if investors are willing to step in and buy bonds at a time when you have this momentum going the other way, pushing yields meaningfully higher.
What a month in September so far. 2-year up something like 20 basis points, but all the price action really has been at the long end. On the 10-year up by more than 40 basis points for the month. On the quarter up by something like 70. Dan Suzuki, from your perspective, what is the dominant force underpinning this move we've seen develop through 3Q?
Well, I think, Jonathan, ultimately, it mostly comes down to growth. I think there's a little bit of supply-demand dynamics going on with treasuries and the significant amount of issuance and less buyers. But I think ultimately, you've had a much more resilient growth environment. People have had to take up their expectations for growth, Fed policy, and that's been the biggest driver of higher interest rates. Now, I think that it's no surprise that that's come at a time where, markets are actually have been selling off a little bit to price in sort of that higher liquidity, higher interest rate, or tighter liquidity, higher interest rate environment. So I think there was a narrative that was, kind of overtook the markets of a Goldilocks scenario of resilient growth and lower inflation. Now, I think a lot of that story is somewhat intact, but I think just people are starting to price in the risk to that story.
Fed President Goolsbee thinks it's intact. He said this: the unwinding of supply shocks, the composition of demand returning to more stable patterns, Fed credibility, central to why he thinks it might be possible today to reduce inflation while avoiding a deep recession. Is that your base case still, Dan?
No, it's, I don't think it is a sustained base case. I mean, I think, the way I think about it is that there's risks on both sides, and I don't think the market was really focused on those risks. I mean, in a better growth scenario, you're going to get higher inflation, and you're going to get a Fed response to that higher inflation. I think that's just where we are. I think economically, we are late cycle. In a profit cycle perspective, we are early cycle. But from an economic perspective, we're at that point where better growth means higher inflation and a tighter Fed. Conversely, if growth at some point starts to slow because of tightening liquidity, tightening credit, then that's another risk that's not being priced into markets. And I think, the shift has been toward the positive growth scenario, and that's why we've had to factor in, the impact of the risks that comes with.
Well, let's discuss the balance of those risks, so to speak. Subhadra, you mentioned those risks are more balanced. Through the summer we were talking, and you would say risk to yields are skewed asymmetrically to the downside. What has brought them into balance for you?
It's the fact that we are seeing investors start to push back on taking down Treasury supply. You are seeing, the tailed auctions. You've seen a really tremendous rise in term premia. Term premia has gone up by over 100 basis points. That's even more than what 10-year yields have sold off in the last month. So the dynamics in the bond market are definitely changing and not necessarily favorable from a demand perspective. So that's kind of what I think has changed. Again, the data has been very supportive. We've been getting okay data. You really need to see the data turn, lower meaningfully in the fourth quarter. I mean, consumer could come under pressure, which is our expectation. Student loan moratoriums end, which is going to, impact the consumer. Savings rates are being depleted. So those are the dynamics that I think ultimately could bring investors back to the safety of bonds. Also, I think if yields remain persistently high, borrowing costs for the consumer are going to go up quite meaningfully. You're looking at mortgage rates, continuing to go up. Corporate bonds as well are going to come under pressure if corporations are going to have to refinance at much higher yield levels.
Subhadra, you mentioned rising term premium. Steve Major over at HSBC wrote this week, that rising term premium is occurring because investors are being asked to receive bonds for less yield than offered in the money market, and at a time when budget deficits are increasing without a recession. Can we just dig into that a little bit more? Subhadra, that discomfort we have with financing the deficit in an expansion, will we find comfort financing it in a contraction? Do we need bad data for this to turn around?
This is a very different time than in the past. You're absolutely right in pointing out that the yields in the very front end are very attractive. So you probably want to stay in shorter duration assets because on a duration adjusted basis, you get, much better returns. But then, over the long end, typically the 10-year yield tends to trade in line with fundamentals. You are seeing some technicals that are pushing 10-year yields higher, but if you're looking towards a growth trajectory that's going to be anywhere between 1% to 2% for the next several years, we're calling for a recession in the U.S. by the middle of next year. Under the circumstances, you should start seeing the 10-year yield trade much more in line with fundamentals. And that would mean that yields will have to decline. Just that right now, as it stands, you're seeing that the demand dynamics and the supply-demand dynamics are not favorable for 10-year treasuries.
Yield to declining this morning, just a touch. We're down about 4 basis points on the 10-year, 4.53 at the moment. On the 2-year, just north of 5%. Plenty of economic data through the week. Looking ahead to payrolls next week as well. Let's get to Mike McKee. Morning, Mike.
Morning, John. Well, it was a very interesting morning in terms of data because we got some contradictory data, at least the past that we were on. We see income and spending come in opposite directions. Income's up 4%, a lot of that wages, while spending also at 0.4%. But that means that income has gone up while spending has gone down, and that's not the story that we have been told. And we were told everybody was spending off of their savings account. You can see the yellow line there. Personal savings went down. And so it kind of confusing as to what direction the consumer is going to go. We were talking about this yesterday, and it's going to be interesting to follow. Now, the other thing that is of great interest to the Fed and everybody on Wall Street is, I'm calling this the end of inflation because we may not get any more numbers coming up soon, but headline inflation comes in at PCE level 3.4%, while the core at 4.3%. The headline is up from the previous month. The core is down from the previous month. And then when you look at the core, super core, and the PCE numbers on a month-over-month basis, you see something very interesting. We're seeing a continuing decline in the core, which is what the Fed wants to see. I'm not sure the supercore updated exactly right here, but basically what happened with supercore is it came in up 0.1%. And here's what analysts are saying. Omar Sharif at Inflation Insight says, if we continue to see something like that, then the Fed is going to be way over in its fourth quarter PCE inflation estimate. We're going to see 3.3% for the end of the year instead of 3.7%. You'd need 0.3 gain every month in order to see the Fed be correct. So that weighs into what people are thinking about what the Fed is going to do, and we're down to a 16% chance of a move on November 1st. And of course, one of the problems is the government shutdown. We're not going to have a lot of data. A lot of the data that we are expecting is going to be off the charts. If that does not happen, September jobs on a Friday, but there's two inflation indexes, and then I had to mention
Fat Bear Week. What is that?
Fat Bear. Every week, the Park Service up in Alaska, they have bear cams, and they take pictures of the bears, and the bears are all feeding to get as fat as they can before they get into hibernation. And so the American public can look at this website, and you vote on who you think the fattest bear is.
Nice. Okay.
And they're not going to be able to do that because the law would prohibit them from updating the internet.
Right.
If we're out of work. And I think that's the breaking point for the American people.
Not the millions of people that might not get paid, Mike. It's Fat Bear.
It's Fat Bear.
Even the cameraman's struggling to keep it together. Mike McKee, thank you, sir. Inflation and disinflationary trends. Dan Suzuki, if you can help me get out of this hole, I'd appreciate it. Things headed in the right direction. It's happening even with the labour market looking pretty tight. Your line reads as follows. Corporate profits are bottoming. Things are going to get better by cyclicals. Dan, why is that?
Well, I think, part of this is just, you create a lower base off which to grow. It's easier to grow. So, there's been I think what a lot of people don't realize right now is there's been a decoupling of the economy, parts of the economy, and the economy with profits. I mean, we've basically had this decoupling of goods and services since the pandemic, and that's still with us. So, you've had this, services boom, the goods side of the economy, whether it's manufacturing, goods, shipping, corporate profits, all that stuff has been in recession. Now, that's persisted, and all the indicators suggest that that's actually starting to improve, whether it's industrial momentum, PMIs, even the labor market's showing signs of life in jobless claims. So I think that in that environment, you're going to see corporate profits improve off of these, depressed levels, and that's going to support, cyclical assets. Now, whether that translates into a better economy remains to be seen if that decoupling, persists. You could have an environment where this services economy continues to gradually weaken. At the same time, profits improve. I mean, that's been par for the course for the last few years.
So, Dan, when you say cyclicals, what do you mean precisely? Energy, banks, where are you looking?
Yeah, I mean, if you look at the broad sectors, I mean, to me, there's cheap cyclicals and expensive cyclicals. Obviously, a lot of people don't even consider technology-related names to be cyclical, but they are. That's an expensive source of cyclicality. So I think, the type of cyclicality that I think is most attractive here is traditional cyclicality. Now, both will benefit, but one trades at like a fraction of the multiple of the other. So I think you can get better growth, better earnings growth at cheaper valuations. I mean, to me, that's a no-brainer.
Dan Suzuki alongside Subhadra Rajappa, sticking with us going into the opening bell about 17 minutes away. Equities near session highs here, up by 0.7% on the S&P with some movers. Here's Abby.
And John, we're looking at the best 2 days since August 30th. And if you recall, the rally at the end of August prevented the worst month of the year. Let's see if that happens for this month. As for what is really helping out the boost on the day, take a look at Nike, up about 11%, a big profit beat. Their inventory fell, and the CFO is saying that they're comfortable with their current inventory, currently heading to its best day of the year. Carnival up 3% ahead of reporting earnings, expected to set the tone for travel. And then Tesla, despite the third quarter estimates being lowered to 445,000 units from about 515,000 units by Piper Sandler, well, that analyst says the stock is likely to go higher anyway, and so it is this morning.
Really strong, powerful moves from Nike going into the opening bow. Abby, thank you. Much more from Abigail around the cash open in about 16 minutes' time. Coming up, it's crunch time on Capitol Hill.
The American public has a less voracious appetite for shutting the government down than they did maybe 10 years ago. 10 years ago, I always argued the Republicans won by shutting the government down.
Team coverage up next.
Freedom Caucus, they'll win if they shut the government down for a couple of days to make their point. They get more border security money, and they open the government back up in about a week. Does some damage, but they end up, showing their muscle, and then border security. But it also helps Biden. This is what I don't understand about the Republicans. You're going to waste money with a shutdown, then you're going to get more money for border security, and Biden benefits from that.
The clock is running out in D.C. with less than 48 hours to go until a possible government shutdown. Both the House and Senate continuing work on separate stopgap measures. House Republicans still worried about their lack of a coherent message. Speaker Kevin McCarthy says they'll press on.
We work through this and get it done. I don't give up. You work until you get it done, and that's what we'll do. We're not going to walk away. We're not going to go hide in people's corners. We're going to be adults in the room, and we're going to sit down. What does it take to get there?
All this as GOP hardliners plot an attempt to remove McCarthy as Speaker as early as next week. Let's get to the team coverage. Bloomberg's Anne-Marie alongside Katie Lyons in Washington, D.C. MH, what's the state of play?
Well, today is going to be a key test for Speaker Kevin McCarthy because, Jonathan, he's going to put a stopgap funding measure on the floor. It's called, as of this morning, Spending Reduction and Border Security Act. Will keep the government open until October 31st. 30% reduction pretty much across all agencies, barring Veteran Affairs, Homeland, and Defense. The issue is, not sure if he has the votes yet, Jonathan, and that is why this is going to be very difficult for Speaker McCarthy, because if he was to then, say, potentially put on the floor the Senate's version, those hard-right members might want to oust him.
Katie, is it a shutdown or his job? Is that the choice?
It seems like that might be the choice for Speaker McCarthy, or at least run the risk of losing his job, because he has had this threat of a motion to vacate hanging like a sword of Damocles over his head for basically the entire duration of his time as Speaker of the House, John. Really, it's one individual, Republican Matt Gaetz from Florida, who has been leading this charge, threatening this motion. But the thing is, the motion would still need to pass. And I have spoken to multiple Democratic members of the House who have suggested that if McCarthy were to work with Democrats in a bipartisan measure to avoid shutting down the government or get the government funded, they would be willing to step in to help him retain his seat as Speaker. One Congressman, Jim Himes of Connecticut, told me that Democrats would do that over choosing chaos, given how chaotic the Republican Party in the House does feel at times. So it is seeming like there might be a binary choice here. That doesn't necessarily mean that Speaker McCarthy couldn't come out of it on the other side, but it does speak to the fact that he is really beholden to certain members of his party, or at least having to run the risk of going through that whole exercise.
Of course, Anne-Marie, this has not been the focus of the last 30 minutes in Washington, D.C. after the passing of the 90-year-old senator from California.
Yeah, Dianne Feinstein, Jonathan, has passed away at 90 years old. Of course, her health has been a focus, really, over the course of the last few months in Congress, and a bigger conversation about our aging elected officials. But today, the focus will be on this individual as a trailblazer and her legacy. She was elected to Congress, Jonathan, in 1992. It was the so-called Year of the Woman. And her most notable achievements that you're going to hear everyone want to talk about today is her bipartisan work on the assault weapons ban and also a leading voice for gay marriage in this Congress. So while there's going to be a lot of talk, of course, about the future of the Senate makeup and who potentially will replace her, today will really be about her legacy.
MH, thanks for the reporting down in Washington alongside the brilliant Katie Lyons. The latest on Washington ahead of that looming shutdown deadline. Dan Suzuki, we can just go through the list at the moment. Government shutdown, higher rates, higher energy prices, student loan repayments, take your pick at the moment. Dan Suzuki, the headwinds for the consumer, are they real this time? Are they actually going to hurt consumption?
Yeah, I think on the margin, John, they are going to hurt consumption. I mean, everything that you just mentioned is real, and there's more on top of that. But I think that you have to understand where we're coming from, and that's a place of incredible strength. So if you look at household net worth, I mean, we're coming off of basically all-time highs. You look at things like the financial obligation ratio. Those things are incredibly healthy. I think that there's going to be a lot of persistent resilience in the consumer, but on the margin, I don't doubt that it's going to slow. I mean, overall income growth which is basically the product of jobs, wages, and hours, has been slowing for some time, but it's still at these really healthy levels, that are above the historical average. So I think that you got to kind of, you got to weigh both sides of this and understand that these things are going to continue to weigh on growth, but that it's not going to collapse anytime soon.
Subhadra, going into Q4, looking at volume 4 of why the consumer is about to break. Subhadra, why won't we just see even more resilience going into a new year?
We don't really, our base case is that we don't expect any resilience going into the new year. I completely agree with what Dan was saying. The consumer is going to continue to come under pressure. But we also have somewhat of a haves and have-nots, economy, where I would say that delinquency rates are rising in auto loans, in credit cards, but it's affecting a very specific cohort of the U.S. Consumers, and then you have the rest of the consumers where you probably have a lot more savings and are not in the same situation. So we'll have to track, when you track sort of the aggregate numbers, you're not seeing that kind of weakness that you should see because of the fact that we've had a very, very strong third quarter. But we believe that the summer splurge will end, and fourth quarter is when you're going to start seeing the consumers start to slow down meaningfully. But ultimately, this is an economy that's going to be led by a tightening of corporate profit margins. Corporate profit margins have declined, and I think that over the upcoming quarters, you're going to see more of that. And that's ultimately what leads us into a recession by the middle of next year.
Dan, I know you might take the other side of that, so final word, top pick in this equity market at the moment.
So, sorry, say again, what was the question?
What's your top pick in this equity market, Dan, at the moment?
I think right here, I like energy. I think it's... we think that growth and energy demand globally is going to be picking up with the corporate profits recovery. I think energy is still an incredibly cheap way to play cyclicality, but there's a huge menu of things to buy right now, whether it's energy, industrials, financials, value, emerging markets. I buy the whole gamut.
That good. Dan Suzuki. Thank you, sir. Alongside Subhadra Rajappa, seeing things slightly differently at the end there. Going into the opening bell, your morning calls, and later, BlackRock's Kate Moore joins us around the open on why she thinks the economy is less sensitive to higher rates this time around. That conversation just around the corner. Stocks are positive. Let's get you some morning calls. First up, Loop Capital upgrading Bumble to buy from hold, citing the firm's cash balance, effective use of interest rate swaps, and free cash flow generation. Your second call from Bank of America upgrading AB InBev to buy from neutral, seeing signs margins are at an inflection point as cost of goods sold pressures have started to ease. And finally, Jefferies raising Bull Corp to buy $64 price target, pointing at valuations returning to pre-COVID levels and re-accelerated free cash flow. Coming up on this program, BlackRock's Kate Moore joins us around the opening bell with her thoughts on how higher rates will impact the economy. Your opening bell up next. Let's get you to the weekend. Your opening bell about 22 seconds away on the S&P 500. There's a lift here on the S&P by 0.75%, attempting to end this month, this quarter, this week on a high. The Nasdaq 100 up by almost 1 full percentage point. Going into Friday, it's down on the week, it's down on the month, it's down on the quarter. There's your opening bell. Switch to the board and get to the bond market. Yields look like this. Yields are down on the session. They are up big time on the month. We're down 5 basis points, 451.79 after having a little look at 470 yesterday, at about 468 at the high of the session yesterday intraday. In the FX market, the euro trying to make a comeback. What a week it's been for the single currency. Had a look at 104, had a sneak peek at 106, came all the way back down to 105.88. That currency pair firmer on the session, up by 0.2%. That's a stronger euro, a weaker dollar. And crude 95 intraday yesterday, backing away from that level. Eventually, 92 at the moment, up on the day by about 36 cents, up by 0.4%. 30 seconds into the session, state of play. It looks like this, up 0.75% on the S&P, on the Nasdaq up by 1 full percentage point. One stock to watch at the open is Carnival, the cruise line company reporting third quarter revenue that hit an all-time high. The company's CEO saying, quote, "I continue to be encouraged with our revenue trajectory heading into next year as we see no signs of slowing from consumers." Abby had this one. Hey, Abby.
Well, John, this stock is all over the map. Now, going into the report, the stock had been higher then, initially up 8%, then very quickly down 5%, right now up about 3%. So let's take you through some of these headlines. So for the quarter that they just report, they did beat estimates for earnings. It came in stronger. On a year-over-year basis, last year it was a big loss of about 65 cents. GAAP earnings this year, 79 cents. So much improvement there. Revenues were a little bit higher as well. They're also talking about bookings for 2024 being locked in. But what had the stock down initially or momentarily was the fact that they're now seeing a fourth quarter earnings guide of a loss of 18 cents to 10 cents, or I should put that 10 cents to 18 cents. The consensus is at a loss of 10 cents. So it seems as though investors, though, are working through what this could mean. And they're also, on an adjusted basis, talking about 4 cents to 12 cents. The consensus was at 16 cents. So I think that that's probably what has the stock higher. We'll be working through these numbers, and we now have at least Royal Caribbean. I haven't taken a look at Norwegian yet, trading up in sympathy, but it seems as though the cruise industry, a little perplexing to me, going strong.
You and I both, Abby, thank you. That stock is up by about 4% at the moment in early trading. A decent move for that name. If you want a bigger move, look to Nike. That stock up by close to 8%. Shares rising there after the company beat profit estimates and saw a bigger than expected drop in inventory. The CFO saying this: "We're very comfortable with the level of inventory in the marketplace in relation to the retail sales we're seeing." Simone Foxman on top of this one. Hey, Simone.
Hey, John. Yeah, and this end of this inventory glut seeming to be the end of discounting pattern that we have seen in the stock. And that's why Morgan Stanley's saying a bottom may be behind the company. Despite this now 7.5% jump today, we're looking at shares down over 17% year to date. So the reaction to a better than feared set of earnings coming in here. Overall revenue actually underperforming slightly, up 2% year on year. But there were signs that the U.S. consumer may not be as pressured as everyone had feared. North America accounts for about 42% of the company's business, and same-store sales falling 1%. They had been seen to be falling more than that. Europe also exceeding expectations. The concern, however, China underperforming in same-store sales, still up 12% year on year, but most expectations had been for over 15%. Jefferies analyst Randall Kotick telling us yesterday he is very concerned about the potential for China volatility, as well as some market share losses on the fringe, especially in running shoes. But the emphasis on cost cuts, margins that were better than expected, part of what's driving the surge in Nike shares today, the most since December.
There we go. Simone, thank you. The stock is up by about 8%, 7.6% right now. To Simone's point, it's all relative to expectations. And after what we saw with Dick's Sporting Goods and Foot Locker, that wasn't great at all. This is better. Jefferies aren't alone. This came from BMO today. BMO Capital lowering its price target on the stock to 110 from 120, citing growing concerns about the Chinese and North American markets. That's the concern. The stock this morning is higher by 8%. Let's turn to tech. Bloomberg reporting Microsoft discussed selling Bing to Apple in a deal that would have replaced Google as the default iPhone search engine. Ed Ludlow, how about this one?
Yeah, it's interesting, Jonathan. Apple up 0.7%. It had been up in the region of 1% in the early minutes of Friday's session. Do we draw a causal link with the Bloomberg reporting and the share move higher on Apple and Microsoft? Probably not. But according to Bloomberg sources, in 2020, Microsoft execs met with Eddie Q, who's Apple's services chief. They had early stage talks for Apple to acquire Bing, Microsoft's search engine, and make it the default search engine on iPhone. Those talks were exploratory. They never reached an advanced stage. And of course, Google remains the default search on the iPhone. But the point here is that in the background, the trial is ongoing between the Department of Justice and Google over dominance of its search product. Apple and Google, the parent company now known as Alphabet, have had a search deal in place since 2002. It started with the browser for Mac and it has expanded to other devices. And as we have learned through the course of this trial, this is a piece of business for Apple that ranges from $4 to $7 billion annually in what Google pays Apple to have its Google search engine prominent on Apple's device base. When Eddie Q, the Apple Services chief, gave his testimony in recent days about Google search dominance, he basically explained that Apple and iPhone use Google because it's the best product. So this is a backward-looking piece of Bloomberg reporting. The stocks are notably higher in a market that's up 1%, I think you said, on the NASDAQ 100, John.
Yeah.
But goodness, imagine if that had gone through.
Well, it's one for the history books, maybe. And I do wonder whether the AI frenzy that's happened since changes the prospect of anything happening ever again.
Yeah, it's interesting. You know, lots of hypotheses have been put forward broadly on M&A, whether Apple would actually be able to do anything in this environment under Lina Khan's FTC. But, you know, Apple has kept quiet on the AI front in terms of a generative AI tool, consumer-facing generative AI tool or chatbot, but they've really talked up their history and competence in machine learning and AI. So I think it's interesting insofar as that, you know, Google hopes to maintain a lead in search. And the point with Bing is that it would have been a competitor. AI is now very relevant to the search market, but Bing remains only 10% of it. So it is very backward looking, and it is a what might have been, but it also gives you a kind of lens into what Apple thinks about when it does think about M&A and when it does think about being competitive itself.
Interesting. Looking forward to the programme. As always, Ed, a little bit later, midday, noon Eastern. Ed Ludlow, Caroline Hyde on Bloomberg Technology. We're about 7 minutes into this session. We're positive still, up by 0.6% on the S&P. As Ed mentioned, we're still higher by about 1% on the NASDAQ. Let's look at food delivery services. Uber, DoorDash losing a challenge to a New York City rule mandating an hourly rate of at least $17.96 for delivery workers. Uber saying the law will put thousands of New Yorkers out of work, and DoorDash saying, quote, extreme pay rate will reduce opportunity and increase costs for all New Yorkers. Katie Greifeld on top of this one. Hey, Katie.
Hey, John. Yeah, we're talking about the likes of Uber, DoorDash, Grubhub, etc. Like you said, they now must pay their food delivery workers at least $17.96 an hour. Of course, that's thanks to that Thursday's decision from the New York State Supreme Court. So either the companies must pay that flat hourly rate or pay per delivery at about 50 cents a minute. And as you can imagine, the pushback from the companies was immediate. As you walked through, Uber saying in a statement on Thursday that this law will put thousands of New Yorkers out of work and force the remaining couriers to compete against each other to deliver orders faster. DoorDash said that it's evaluating its legal options and that this is a deeply disappointing outcome for delivery workers, merchants, and customers alike, and saying, too, that this, quote, extreme pay rate will raise costs for all. So it sounds like the company plans to pass on those higher costs to its customers. But as you can see, the shares of both companies, both Uber and DoorDash, a little bit higher this morning. It sounds like we'll be hearing about this on the earnings calls to come.
And Katie, thank you. Appreciate the update. Higher across the board at the moment. Seemingly the story up for a third consecutive day on the S&P 500. Interestingly, if we close here on the S&P for a third day of gains, that's the longest winning streak daily of the month so far, for the month of September, as we close out this month and look ahead to October. Stocks rebounding then to start the last trading day of the quarter as dovish comments from Fed policymakers ease some fears of further rate hikes. Kate Moore of BlackRock weighing in saying, quote, the dominance of services in the U.S. economy makes it much less sensitive to higher interest rates than during previous hiking cycles. Kate, I'm pleased to say, joins us right now. Kate, always wonderful to catch up with you. A good friend of mine in a bow tie always talks about companies adapting and adjusting, and I noticed that same line in your notes too. Katie, we're underestimating maybe what they can do in the quarters to come and perhaps overestimating the importance of what's developing in the bond market.
Yeah, I mean, John, I think this is a major theme, and it's been a major theme for well over a decade, I would say, since post-GFC. Companies have been fast to adopt to changing conditions, whether that's higher policy rates, lower liquidity, changes in consumer preferences, changes in geopolitics or policy. And it just really boggles the mind that people continue to believe that companies will not adapt and change. We need to start giving, especially U.S. corporates, a little bit of credit here. And I think one of the major themes we've seen this year from some of the companies that have outperformed the broader market is they took some of the pain. You know, after share price declines last year, they cut costs. They took their foot off the accelerator in parts of the businesses that were frankly, not going to generate a lot of growth. And they really streamlined what they needed to in terms of their operations to deliver better results. So I am a big believer in the flexibility and the adaptability, especially of U.S. companies, and I would not count them out.
Kate, can you say the same thing about financials, about the banks, given their experience this year?
I think financials, John, I know why you're asking me this, are a very different cat altogether. There's a different regulatory environment, there's a different demand environment, there's a different rates environment. I would say financials are a more challenging sector to put a lot of money behind at this moment. And I think you have to be very selective in the names that you choose.
We talked about the relevance of yields to profits, interest rates, to what's happening in corporate America. Can we talk about that with regards to the financials, Kate, with a little bit more detail if you can? Are yields and higher yields good or bad for financials? Because you and I have talked for a long, long time, for the best part of a decade together, and we'd sit here and talk about the relationship between the 10-year and where financials and stocks are priced. Kate, where's that relationship now?
You know, it's as you know, and this is why you're asking this question, it's much more complicated. And the problem is, John, you used to be able to look not just maybe at the whole banking system, but at segments of the banking system and say, this group is particularly interest rate sensitive. This group is going to see net interest income and margins expand in this environment, and this one is going to suffer. But it's not quite so clear as banks have changed their operations. They've shed assets as they have, become a little bit less sensitive in some cases or less adaptable to changing interest rates environments. Not everyone is benefiting from higher policy rates. We, of course, are seeing a ton of money, as we know, flow into money market funds and people sitting on their hands there. So there's an opportunity as banks have kind of taken in, more deposits, and then their wealth management sides have seen inflows into money market. But it's not a one-size-fits-all trade, and this is why I'm saying we have to really choose our names here.
Let's choose a sector. Energy. Mark Haefele, UBS, earlier this morning, surveillance with Tom, Lisa and I, saying he likes energy. Mike Wilson, Morgan Stanley, earlier this week saying the same thing. Kate, where are you on energy names on the S&P 500?
Yeah, and I heard Dan Suzuki speak a little while ago, earlier, before the Open. I agree with all of them that there are opportunities within energy, but I think we need to be realistic about it and say, even if some of these companies start generating kind of larger profits because of higher oil prices or because they continue to exert capital discipline, which has been really good for their overall sustainable profit story, there are significant headwinds on the energy side. If there are changes in demand, and we know demand has been quite strong, and that's been a major force underpinning the rise in oil prices. If there are changes in demand because economic activity slows, I think we'll see a quick reaction in a lot of these stocks. So I think you have to be more tactical in this sector. It is not a buy it, set it, and forget it. And I think you want to really stay up in quality.
Does a buy and forget it exist right now, Kate, for you and the team?
No. I think this is an environment, a market environment in general, where being more tactical and being on your toes is necessary. And I think that is going to be a dominant theme going into year end. We have all of these cross currents. You guys were just talking about stuff going on in the consumer. Some companies reporting actually fairly good activity, others reporting very weak activity, particularly from low end consumer. And we can't just make one blanket statement around the sector or around the market. So yes, I think you have to stay on your toes, be more tactical, and spend your longer term research hours on the big themes, but understand that you're gonna have to trade around them in the near term.
Kate, it's been way too long. Let's do this again soon. Kate Moore, thank you from BlackRock on the latest view from the BlackRock desk on the equity market at the moment. About 14 minutes into the session, a better stock market on the day relative to what we've seen over the month and a quarter. On the S&P 500 up by 0.6%, on the Nasdaq up by 1 full percentage point. Coming up, pressure building as another UAW strike deadline approaches.
This week, we've received some shocking reports of violence against our members on the picket lines. We condemn this violence that GM and Stellantis are enabling. These attacks on our members exercising their constitutional rights to strike and picket will not be tolerated.
Team coverage up next.
This week, We've received some shocking reports of violence against our members on the picket lines. We condemn this violence that GM and Stellantis are enabling. These attacks on our members exercising their constitutional rights to strike and picket will not be tolerated. Let me be clear. Fighting for economic and social justice isn't a crime. It's our civic duty.
Tensions rising on UAW picket lines as the strike hits its 2-week mark. Union President Shawn Fain calling out GM and Stellantis for alleged violence. Automakers pushing back, GM calling Fain's remarks inflammatory. Stellantis saying, quote, "The companies are not the enemy. We are not at war." At 10 a.m, Fain is expected to announce another round of strikes starting at noon if automakers don't budge. And this time, Ford won't be spared. Union pay raise demands sliding down to about 30% based on our reporting, with counteroffers remaining at around 20%. Let's get to the team coverage. Bloomberg's Anne-Marie in Washington, D.C., the brilliant Shelley Banjo here in New York. Shelley, first to you. How wide is the spread between automakers and this union right now beyond just what is offered on pay?
So they came out saying we want 40% or north of 40%. The car companies came out with 20%. Our reporting this week revealed that a palatable number, a key target, would be that 30% number, that the unions could feel confident in, that they could really get, really come back and bring that back to their members as a win. But there's so many other issues. There's things like pensions and job security and temp workers, and there's a number of issues at the bargaining table, not just that top line pay number.
Shelley, Ford out of the firing line from some of those more prominent comments we cited just moments ago. Are they in the firing line in about 10 minutes' time?
You know, that's what we're going to see in just a few minutes to see if they name another Ford plant. What happened last week was they said, OK, we're seeing some progress at the bargaining table from Ford, so we're going to spare them. But they didn't stop the strike that they had already going at the first Ford plant. So they're really, this whole strategy is around flexibility to show publicly what kind of respond publicly what the progress is at the bargaining table.
AMH has been quite a week, hasn't it, with the President of the United States at the epicenter of a lot of this stuff.
That's right, Jonathan. The first time ever you see a president go to the picket line, voicing his support, going beyond really just putting his thumb on the scale towards the union workers. And yesterday he tweeted that they should stick with it. And in this tweet, Jonathan, you see a video of the president, and there's one line that really struck out to me. He says, "We save them," meaning the big three. "It's about time for them to step up for us." And what is so delicate at this moment right now, Jonathan, for the White House is that potentially we're going to see expansion of these strikes, as we just heard. On top of that, we are less than 48 hours from a government shutdown. And if you include $100 for a barrel of oil, that is the difference between a recession or not, according to Bloomberg Economics.
Amazing. AMH, Shelley Banjo, thanks for the update, guys. Appreciate it, as always. The big debate continues. Are those strikes going to be extended, prolonged, deepened? We're going to find out potentially in about 9 minutes' time when we get that UAW news conference, if we can call it that Facebook Live event taking place at 10 a.m. Eastern Time. The broader market going into all of this is doing OK. 8 minutes away, or rather 8 minutes away from that happening, 22 minutes into this session. Equities are up here by 0.6% on the S&P. The Nasdaq higher by more than 1%. Abby has the sector price action. Hey, Abby.
Hey, John, and it's solid sector action. Actually more robust, I would say, than the overall gain of about up 0.6% for the S&P 500. In other words, risk on. You have discretionary, tech, real estate, and utilities all up more than 1%. These are some of the most rate-sensitive sectors. So right now, getting a bid to the downside has been this quarter's big winner. Down 1% is energy. Let's turn right to the quarter because we are, of course, looking at the best quarter, the worst quarter in a year since this quarter last year. Energy up 13%, the one of three sectors that's higher, the most since December of last year. Utilities, John, down 8.1% as those dividends look less attractive. That's the worst quarter since March of 2020. And then we also have real estate, also a dividend-sensitive sector, along with commercial real estate issues, down 8.4%, the worst sector in a year. So quite a bit of drama this quarter. Let's see what the fourth quarter brings.
This has not been a September to remember for good reasons, that's for sure. Abby, thank you. About 23 minutes into the session, then equities higher on the S&P and on the Nasdaq as well. The potential for a third day of gains. Your trading diary up next. 25 minutes into the session, equities higher for a third consecutive day. A three-day winning streak on the S&P, the longest winning streak of September so far as we close out this month and go into October. We're facing the potential of a fourth week of losses on the S&P 500, with this move now just about positive on the week over the previous 4 days, including early this morning. The S&P higher by 0.6%. That's the price action. Let's get to the trading diary. The week ahead, the day ahead looks like this. UMich consumer sentiment at the top of the hour, plus UAW President Sean Fain making an announcement on Facebook Live. Saturday, the government shutdown deadline coming at midnight. Tuesday, FTX co-founder Sam Bankman-Fried's sweeping fraud trial begins. And Friday, the September payrolls report, which could well be delayed, if Congress fails to fund the government. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. And as always, good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.